Now let's get back to today's big sell-off. Speaking of, what should investors do if a Fed rate cut is no longer a guarantee and the markets seem to be on a bit less stable ground? Joining me now is Innovator Capital Management Chief Investment Strategist Tim Urbanowitz and Citi U.S. Equity Strategist Drew Pettit. Guys, welcome. Drew, good to have you here on set. So with today's action, we're falling back about 3 weeks on the NASDAQ and S&P, 3 days on the Dow. Is this a canary in the coal mine or just a healthy pause that refreshes?
I think it's a healthy pause. Like, we got to realize when we were coming into earnings season, we had a lot of good news priced in. When we do a lot of our work, it's fair value based. It's not about sentiment. That's not how we set price targets. We're at 6,600 at year end, a bull case at 72. So good news priced in. So when you get good news, not great news, not beat and raise again for next year, it's pretty healthy and normal for investors to take profits. We think that creates some buying opportunities into the end of the year and potentially into 2026.
Okay, so Tim, you think the Fed probably doesn't cut in December? Do stocks fall farther in that case?
Well, John, anytime you have a market like we have now where the valuation is so high, it's very sensitive to bad news. And I think today was just investors recalibrating their expectations that you might not see that December cut or maybe not a cut even in January. And this has been our view. We do think that you are going to see the Fed on hold. We've seen 150 basis points worth of cuts over the last 14 months. This is right about the time where we start to see what those cuts actually do in the economy. What's the impact going to look like? And we've honestly been pretty surprised with how confident the market has been that these cuts are coming. If you look over the last 14 months, we've had core inflation that has really been stuck in this 2.75 to 3.25 range. If you look back to the 1970s, we've had 50 Fed meetings where core inflation is in that range. They've only cut at 2 of them outside of this current cycle. So the step back in confidence, I think, is warranted. We don't see bigger problems. We think this is a good thing, but we do need to see those expectations recalibrated.
So, Drew, you say you didn't set the targets based on feelings. It was based on the data. We're dealing with less data than usual now as we're just coming out of a government shutdown. How do you factor in the lack of macro data into how perhaps you ought to be recalibrating, if you should, heading into the end of the year?
Okay, so this only applies to, I'm going to say, like the left side or like the scientific side of the brain when it comes to macro data. The other half, the right side, creative side, is structural and AI. I don't really need the macro data to tell me that there's still strength there. So we still feel really good about the growth side of the market. We feel really good about productivity enhancement. That's all micro data. Government shutdown or not, I'm still getting my micro data. On the macro side, I think the reaction today is really just an unwinding of a soft landing trade. I think that's where there's question marks. You're seeing that pain in small cap. We talked about that being a really interesting place to add beta going into the end of the year. That's what investors sold today. That's where there's less conviction when you don't have that government data.
Okay. Tim, you've got an ETF call?
We do, John, and we think right now it's about risk management. You have to prioritize risk management. Again, that all comes down to how much good news we have priced in. We talk to advisors all day. There's a lot of concern. Are we heading into an AI bubble? So one of the strategies we like for the next year, ticker QFLR. This is going to give investors exposure to the NASDAQ 100, participating in about 70 to 80% of the upside, while making sure that we're capping losses over a year right around 10%. So we think this is a great strategy to give you that upside participation, really keep your foot on the gas pedal when it comes to a lot of those tech stocks like NVIDIA that have been doing well. We think are going to continue to do well, but also making sure that we're paying particularly close attention to the risk management element. Again, with valuations where they are, we think that needs to be #1 priority.
Okay. Drew, since Tim's talking defense there, I'll ask you more strategically, how should investors factor in defense in their portfolio right now?
Yeah, it's funny. I actually think a good defense here might be a good offense. And it's just taking money that you have sidelined and buying growth on a pullback. Honestly, we think you should probably be taking the relative outperformance of defensives these few days and rotating it into beta, into tech, into financials. Those are really interesting, I think, relative trades and moves you can make on these pullbacks.
But it sounds like you're saying you ought to have money on the sidelines.
maybe that's not what we're saying, but that's what investors are doing. Let's put it that way.
So if you've got it, then the defense is to put it in on the pullback.
Yeah, and if you don't have it on the sidelines, it's rotating out of the defensives that have outperformed, that really don't have good structural earnings growth.